guys, welcome back to the channel. It's been a while since I posted anything recently. Today I'm going to talk about 3 stocks to watch for January 2019. As always, if you like these videos, please click the like button below, and also don't forget to subscribe so that you can be notified when other videos come out. For my 3 stocks to watch January 2019, I am going to highlight 3 ETFs instead of stocks, and I'll share why as well. They are VTI, SPHD, and OGIG. First, what is an ETF? An ETF, or exchange traded fund, is a marketable security that tracks a stock index, a commodity, bonds, or a basket of assets. Although similar in many ways, ETFs differ from mutual funds because shares trade like common stock on an exchange. The price of an ETF's shares will change throughout the day as they are bought and sold. The largest ETFs typically have higher average daily volume and lower fees than mutual fund shares, which makes them an attractive alternative for individual investors. Why am I more interested in ETFs this month? The market has been extremely volatile this past year, from tech sell-offs, uncertainty with the trade war, and just overall pessimism in where the economy is headed. The markets have taken major losses in the last few months and more recently have regained some lost value post-Christmas. With that said, I feel like the markets overall may be at a good buying point. As with any investing, make sure you do your own research and know what you are investing in before you ever throw your money into something. The first ETF is VTI. VTI stands for Vanguard Total Stock Market ETF, and it tracks a cap-weighted index that measures the investable U.S. equities market, encompassing the entire market cap spectrum. So what this means is that this ETF, you're going to be getting the entire market when you invest in it. And in a little bit, I'll show you what it includes. In an article from Seeking Alpha, it says, stocks have taken a beating over the past few months, and there have been multiple reasons for the volatility. The US and Chinese governments continue to go back and forth on trade, the Federal Reserve has given conflicting statements on interest rates, and investors are worried earnings growth may have peaked. Given this backdrop, investor pessimism among retail investors is currently sitting at high levels. Rather than using this as an excuse to sell, I believe it is time to put any outstanding cash to work and dive into equities. VTI represents a diversified way to do this by holding large positions in multiple sectors. Furthermore, I believe in the contrarian position that the best time to buy is when the majority opinion is negative about stocks, and that seems to be the case right now. Finally, I expect economic growth in 2019, even if it is at a slower rate than this year, which should be beneficial for the market throughout the next 12 months. So whether you believe that or not, I definitely think there's some pretty good points in this article. Here is a chart of the top 10 sectors for VTI. As you can see, technology makes up 23% of the fund, and financials makes up 17% of the fund, with healthcare at 14.4%. Here we take a look at what is making up VTI in regards to each company, and if you can see, not one company dominates this fund, but Microsoft, Apple, Amazon are your top 3, and the other ones you can see are big names and ones that you would definitely want to be players in a fund like this. Here's a look at the numbers over the last 52 weeks. I'll be doing a video to explain what these different statistics mean, but just wanted to give you guys a quick snapshot of what it looks like over the last 52 weeks. With that said, I also wanted to go and take a look at what it's done in the last 3 months. In the last 3 months, it has gone down more than 15%. As you can see in the charts, the past year, it's down 6.5%. And over the last 5 years, though, as you can see, being a long-term investor is important. You can see that it's up 46%. So, as always, making sure that anytime you're investing, you're thinking long-term. The second ETF to watch for January 2019 is SPHD, which stands for Power Shares S&P 500 High Dividend Low Volatility ETF. This ETF tracks a dividend yield weighted index comprising the 50 least volatile names chosen from a shortlist of the S&P 500 75 highest dividend yielding securities. There's an article from MarketWatch that really puts this fund in layman's terms. The fund prioritizes dividend yield over low volatility, said Morningstar in a recent note. It starts with the 75 highest yielding stocks in the S&P 500. To limit risk, the fund ranks all stocks that pass its initial screen on their volatility over the past year and removes the most volatile 25. Volatility isn't a perfect measure of risk, but less volatile stocks tend to have more stable cash flows than their more volatile counterparts and generally hold up better during market downturns. Low volatility strategies aren't designed for 100% upside capture. Rather, funds such as SPHD are designed to perform less poorly when equity markets decline. Still, over the past 3 years, SPHD has modestly outperformed the S&P 500 while being 100 basis points less volatile. When considering the Federal Reserve has raised interest rates 8 times over the past 3 years, SPHD's outperformance of the S&P 500 is all the more impressive because the ETF has usually been heavily allocated to rate-sensitive sectors. The fund allocates 38.52% of its combined weight to the utilities and real estate sectors. Low volatility strategies have recently been in style and rewarding investors. Over the past 90 days, SPHD is up 0.4%, while the S&P 500 has been drubbed. If the consumer discretionary and technology sectors rebound, SPHD could be vulnerable to disappointment because the fund devotes just 8.85% of its combined weight to those sectors. Here's a quick look at the sectors that make up this fund. As you can see, financials and utilities make up a very dominant amount in this fund. And then if you also look at the companies that are made up, you can see that it's spread out pretty well. No company dominates this, and there also is going to be a decent dividend from these companies that you're seeing. Here is a quick look at the technicals for SPHD. This is a fund for someone who is new to investing. Highly recommended. I've read several articles about it as one that is one of your stable funds, and it does pay a monthly dividend, which is nice for people that are looking to create a little extra monthly income. So that is one other nice feature about it. If you take a look at the 3-month, what it's done, once again, this is another reason why I think it's at a good buying point. It's down 7.41%, and the 1 year it's at 6.61%. It's under. But then once again, if you have that long-term mindset, you can see that it's up over 62% in the last 5 years. The last ETF that I have selected for January 2019 to watch is OGIG. OGIG stands for O-Shares Global Internet Giants ETF. OGIG tracks an index of global internet and internet technology stocks selected and weighted by growth and quality factors. This is a fairly new ETF, and typically I like ETFs that are and have been had a proven track record for 5 years or more. But it's also one that is going to give you exposure to multiple countries, as well as a lot of high growth e-commerce internet companies. According to O-Shares, OGIG is a rule-based ETF designed to provide investors with the means to invest in some of the largest global companies that derive most of their revenue from the internet and e-commerce sectors that exhibit quality and growth potential. OGIG focuses on companies that exhibit revenue growth of 20 to 35%, the majority of which you've heard of. The majority of which you've never heard of, O'Leary said, yet they are blowing it away on the top line. Here's a quick look at the basic stats for OGIG. You can see that it is priced very close to its 52-week low, which is, normal for what's been happening in regards to the tech sell-off. Finally, you can kind of see what has actually happened. And this fund, as I said, is very new, not even been open for a year yet, and it has performed very poorly, giving it that contrarian perspective, as far as looking at things that are going down in value with the mindset that it's going to reach its bottom and begin to trend up here soon. Here's a look at OGIG's top 10 sectors, and you can easily see that internet services at 43% is clearly what this fund is about, as well as software at 26%. If you move on to what companies are making up the majority of OGIG, you'll see that Alphabet, which is Google, is making up 6.4%. Tencent, a major player in China, is a big percentage. Facebook, Alibaba, also in China. Amazon, Microsoft, Netflix, and then a bunch of other tech companies that are up and coming. Finally, you can see that OGIG is definitely represented by more than just the United States. The United States is 68% of this fund, but you're also getting a high amount of China, Hong Kong, among other countries. There you have it. These are my 3 ETFs to watch for January 2019. As always, please make sure you seek the advice of a financial provider anytime you're making important investments. I just like to highlight things that I'm seeing, and so maybe it can just give you a different perspective. As always, if you enjoy these videos, please like below. Feel free to comment with any questions or things that you wanted to share. And don't forget to subscribe. I'm Layman, and these are my terms.